Think about your own money and assets, the cash in your bank accounts, any bonds you own, your investments in stocks or funds. They can feel completely independent. You can transfer funds, convert currencies, or invest abroad. Moving your money feels normal, almost automatic. Yet every one of those assets exists within a national financial system. Banks, payment networks, clearing systems, and legal frameworks make those movements possible. Most of the time, that structure remains invisible because it simply works. In the last episode, we examined how high-debt systems manage pressure internally through interest rates, inflation, and financial repression. But those tools share a quiet assumption. Savings remain inside the domestic system. From the perspective of a saver, however, money is not confined. Depositors can transfer funds abroad. Investors can sell domestic bonds and purchase foreign assets. Companies can hold earnings in another currency. When confidence weakens, these shifts become more common, and if they occur at scale, their effects build quickly. Banks lose funding, bond yields rise, and the currency can weaken further. What makes sense individually can strain the system collectively. In response, authorities may intervene. They might temporarily cap how much money can be transferred abroad. Banks may require additional documentation for large international payments. Access to foreign currency may be limited to certain amounts or specific purposes. The assets themselves are not confiscated. Deposits remain in accounts, and bonds remain legally owned. What changes is not ownership, but how freely those assets can cross borders. Policies that limit or slow cross-border financial transfers fall under a broad category known as capital controls. Not all capital controls look the same. Some are direct. Hard controls place explicit limits on international transfers. They may cap amounts, restrict currency conversion, or require approval before funds leave the country. These measures typically appear during periods of acute stress. Other measures operate more subtly. Instead of blocking transfers outright, they introduce friction. Reporting requirements may tighten, foreign exchange transactions may face small taxes, or regulations may encourage domestic asset holdings. These softer measures do not prohibit movement, but they can slow it. From a systems perspective, capital controls influence the speed and direction of financial flows. In open systems, money responds quickly to changing expectations, interest rates, and perceived risk. Under stress, rapid outflows can amplify pressure on banks, currencies, and government financing conditions. Because banks use deposits to fund loans and to purchase government bonds, large withdrawals can tighten domestic financing chains. Slowing those outflows can help stabilize the system. This is where the tension becomes clear. Property owners value the ability to move their savings, to transfer funds, change currencies, or invest elsewhere when risks change. Before we continue, if you think this is valuable, please like. It helps share it with others. Subscribe so we stay informed together. Financial systems under pressure depend on those same funds staying in place. When those priorities pull in opposite directions, the dilemma becomes concrete. Should people always be free to move their money, even if large outflows threaten the system that holds it? The answer often depends on context. In stable, low-debt environments with strong currency credibility, this tension remains mostly theoretical. But in late-cycle systems, the balance shifts. When public debt is high, governments rely heavily on domestic financing. Banks, pension funds, and insurance companies hold significant amounts of government bonds. Domestic savings become deeply intertwined with public balance sheets. If confidence weakens in that environment, outflows do more than move money. They raise refinancing costs, pressure the currency, and complicate the very policies designed to manage debt. In such moments, capital controls rarely stand alone. They interact with other tools. Financial repression keeps interest rates low. Capital controls reduce the risk that savings exit in response to those low rates. Currency management attempts to stabilize exchange rates, while capital controls can limit speculative pressure. Together, these measures form a containment framework, a way of stabilizing balance sheets and buying time. But stabilization comes with trade-offs. Open systems tend to allocate capital efficiently. Savings flow toward higher returns, and investment moves where it is most productive. When movement is restricted or slowed, that flexibility declines. Foreign investors may hesitate, domestic investors may look for alternative channels, and long-term credibility can be affected if restrictions appear unpredictable or prolonged. In the short term, containment can reduce instability. In the long term, openness often supports growth. Different systems balance these priorities differently, and that balance can shift over time. That shift is rarely dramatic. It appears gradually: expanded reporting requirements, stricter documentation for international transfers, new limits on foreign currency purchases, often framed in the language of financial stability or market resilience. On their own, none of these measures necessarily signal crisis, but taken together, they reveal how a system is managing the tension between mobility and stability. The deeper question is not whether capital controls exist in extreme form. It is this: how much friction is being introduced into financial movement, and why? In stable environments, that friction remains minimal. In debt-heavy systems, it can become more visible. And once you begin looking through that lens, patterns start to connect. Capital controls are not simply about restricting transactions. They reflect something deeper. They reveal how a society defines the relationship between private ownership and collective stability. In highly open systems, mobility is prioritized. In stressed systems, containment becomes more central. The balance between the two is never fixed. It evolves with debt levels, confidence, and institutional strength. And how that balance shifts often tells you more about the stage of a system than any headline announcement. If managing financial flows becomes central to maintaining stability, and if finance increasingly operates through digital infrastructure, then another question naturally follows: what happens when money itself becomes programmable? In the next episode, we explore how central bank digital currencies could reshape the architecture of financial movement, and what that might mean for the balance between personal control and systemic stability. Capital Controls is part of TNBC Explainers Module 3, Economy, Money, and Financial Power. Explore the TNBC Explainers course via the YouTube course list, or visit thenextbigcycle.world for the full course overview and background. This is The Next Big Cycle. TNBC Explainers, your guide to understanding the systems shaping the world around you. TNBC Explainers is a growing YouTube course. New concepts are added over time,